Hey there, sonny boy. It's your grandma. And I'm here to tell you that you need to stop investing in stocks. I lived through the Great Depression and there was a massive stock decline, and my daddy lost everything. So instead of putting your money into stocks, you need to invest in government bonds because they are risk free.
Was that pretty good? Was that a good grandma impression? Have you ever heard that before? Has someone ever said, "Oh my God, stocks are so risky. You shouldn't own every company in the world. Instead, you should just invest in safe, risk free federal government bonds because they're going to protect you forever and you never have to worry about losing money." Well, if you ever heard that from somebody, let me tell you, that is complete garbage. Federal government bonds are not risk free because there's this thing called changing interest rates. And when interest rates change, the value of the bond that you're holding also changes. So if you think you're just going to run and go hide in like a federal, intermediate term bond fund and that you're never going to lose money and everything's going to be okay, that's complete garbage. And I'm going to show you how changes in interest rates, which usually follow increases in inflation, which we may see in the future, can actually screw you over pretty freaking badly. So let's go and let's see, first of all, what a bond is. I know some of you don't know what a bond is, and I guess that's okay because I'm more of a stock guy. And after that, I'll show you how interest rates and changes in those rates can screw you over if you invest in a government bond fund. So here we go. Oh, I'm not sharing my screen. Oh my God. Everybody's leaving. Please don't leave. Okay. So here we go. This is a perfect, beautiful, and flawless example of a typical bond. Now, I didn't use a federal government bond because we're going to assume that this is a made-up country. And this country is actually my country. I'm the president. I'm the treasury secretary. I'm the legislature. I'm the jury. I'm everything. I own everything in this government. And this government is called the Federal Republic of Financial Advisors, are complete scum. Now, because I am irresponsible as the president and whatever of this country, I need to borrow money from my citizens. So I say, hey, citizens, if you let me borrow $1 million, which is this number right here, this big million, I will pay you semi-annually, which is twice a year. So every 6 months, I'm going to pay you at an annual rate of 5%. So 5% of $1 million is 50,000. But if you're getting paid semi-annually, you only get half of that with every payment. So it's actually 2.5%. And this bond is going to be a 10-year bond. So I'm literally going to pay you a 5% rate or 2.5% every 6 months for the next 10 years. So you're going to get 20 total payments from me on this $1 million. Now, you may think because, the Federal Republic of Financial Advisors, our scum, is very solid and you can trust the government and you can't lose money with bonds. That's complete BS. And I'm going to show you why. So here's this bond. Here's what a bond looks like. I mean, I don't know. Maybe it's crap. Maybe there's a better way to show you. But this kind of summarizes what a bond is. It's the face amount. You're borrowing $1 million, or the government's borrowing $1 million. They're going to pay you some kind of interest rate, and they're going to split it they're going to pay you either once a year or they're going to pay you twice a year. And they're basically going to say, okay, we'll pay you back the full $1 million after 10 years. So that's what a bond is. Pretty exciting, huh? Now let's go look at the math here. So my bond right now pays 5%. That is the stated rate. I am saying on my bond, I will pay you 5% every year. Now, to value a bond's value fluctuates with interest rates. And you value a bond by taking all of the cash flows of the bond, the payments, the coupon payments, which is just the 5% rate, and then the eventual repayment of the principal, which is the $1 million. You take the present value of that based on the market interest rate, because as rates fluctuate, the value of your bond's going to fluctuate. And think about it logically. If you're promising on this bond to pay somebody 5% per year, and then the next year rates go up to 6%, well, who's going to buy your bond? Probably nobody, because if they can get 6% somewhere else, maybe another Federal Republic of Financial Advisors or scum bond, maybe they can get 6% there. Why would they buy this bond? Now, to entice people to buy a bond that's only paying 5%, they will actually lower the price of the bond to make it more attractive. And that price will match a 6% rate. So going through this, just to make it clear, we have a principal amount. We are borrowing $1 million as the government. That's what the principal is. We have the stated rate. On our bond, I'm saying I'm going to pay you 5% interest on that million annually. Now, if you split that up into 2 payments per year, it's 2.5% annually. Then we have the coupon payment, which is the actual cash that I'm going to pay you every 6 months. That's $25,000. And it makes sense because 5% of $1 million is $50,000. Whereas if you're paying twice a year, you're only going to get $25,000 every 6 months. All right. The bond term in years is 10 years. This is a 10-year bond that matures on March 27th, 2031. And the number of periods, that's basically the number of payments, which if there's 2 payments per year and it's 10 years, you're going to have 20 total payments. Now, right after we issue this bond, this risk-free, perfect investment that can never go down, the market interest rate, what other bonds are selling for of similar, risk and maturity and whatever, is 5%. But what happens if the market rate goes up? What if there's inflation and bond investors are like, hey, you're printing money and I think 5% is too low because inflation is going to erode my returns. I want, as an investor, 6%. So if we change this market rate to 6% for whatever reason, rates are going up, look what happens. Bond value after rate change. The bond is now worth, if you want to purchase this bond, you want to get a 6% rate. So you're actually only going to pay $925,612. So right off the bat, you paid $1 million for this bond. You loaned the government $1 million and it's risk-free. And then all of a sudden you have this paper loss of $74,000 based on a 1% change. That's pretty freaking crazy, okay? So what if rates went up by 2%? What if it's 7% now? Now your bond's only worth $857,000. Now, the same works the other way. If the market interest rate goes down, let's say it drops 1% to 4%, well, your bond actually goes up in value because it's the same thing. If everybody else is going to pay 4% and you're paying 5%, people are going to pay a premium. They're going to pay in excess to get that 5% coupon payment. So as interest rates go up, bond prices go down. As interest rates go down, bond prices go up. So if you're investing in a mutual fund that invest in treasuries, they're risk-free because nobody thinks the government's going to default, but they can still fluctuate in value significantly. I mean, think about in the past, we've had crazy high interest rates. And if you have a bond that's paying 5% and it's over 10 years, let's say rates spike because there's crazy inflation or there's doubts about whether the government can actually repay its debt. If rates went up to 10%, holy crap. Now your bond's only worth $688,000. So it's not risk-free to buy a bond, especially right now with rates so low. Now, I think the average bond now is probably paying 1%, right? Let's say you invest $1 million into a bond mutual fund, and the current rate is 1%. So if it starts at 1%, the bond's valued appropriately. The market rate's 1%, and the stated rate is 1%. But let's say rates tick up. Let's say they keep printing money, and oh my god, we gotta pay for everything. And money just floods into the system, and that leads to inflation. Well, people are going to demand a higher rate because inflation is going to erode the purchasing power of those coupon payments. So let's say rates go up to 1.5%. Boom. Your bond lost $46,000 of value. Oh, actually, did that round? Of course it rounded. Okay, yeah. So if it goes up to 2%, boom, now you lost $90,000. Or 3%, boom, you lost $171,000. So be very careful when you're buying bonds. We are in historically low. We are in a historically low interest rate environment. And if interest rates start to creep up and you've put all this money into this super safe bond fund and then rates go up, you're actually going to go down. Bond funds will go down in value. And it's going to take a long time to recuperate all the freaking money you lost. So bonds are not risk-free. Now, if you want to be careful and you want to park your money in bonds, especially short-term bonds, you can do that, but there's still the risk of losing money. It's just not as great. So the longer the maturity of the bond, the longer the bond is, the more sensitive it is to rate changes. So if you're just putting money aside in a bond fund temporarily, if you want to do it, I rather hold cash personally in a high yield savings account, put it into extremely short-term bonds or put it into inflation protected short-term bonds. That will at least protect you from wild fluctuations in bond prices. So if you're thinking about putting your money in like long-term treasuries, like 30-year bonds, let's see, if the term was 30 years and there were 60 periods, yeah, even a 2% change can lead to massive, massive losses. Or let's say, what went up before? Massive losses. So the longer the duration of the bond, the more likely you are to lose way more money. Okay? So just be very careful. I advise you. I would almost advise you to stay away from bonds for now because they can't go much lower. The interest rates can't go much lower. I mean, they're basically zero. And the only way they can go is up. And if you have a large position in bonds, you're going to get hammered. All right? So just be careful. So they're not risk-free like grandma said. Is it safe to say that no investment is 100% risk-free? Absolutely. There are always, always, always risks. With investing in anything, don't think bonds are risk-free. Even cash isn't risk-free because the cash's value is eroded by inflation. So be careful, understand what you're investing in, and don't lose any money because of inflation, because of government BS. All right? You guys have a wonderful day. Oh, and like and subscribe.